Uh, Good morning, everyone. It's a great pleasure to be here. I don't have a big disclaimer slide, but I will just talk about the future. So it's a forecast. For those who are not familiar with the International Energy Agency, it's an intergovernmental organization who produce scenarios, energy analysis, and our clients are basically governments. And I'll give you a little bit of a policy perspective with the market information. So I'll just give you a little bit of a context how we operate right now. So first of all, we had a record year in 2015 for renewables, not only in terms of capacity additions, which were about 153. These followed with additional records, which I think should be noted to give you a trend where we are going. The first one is that the installed capacity in 2015 was a record with 153. The second one, record level of solar PV installations were installed, about 49 gigawatts. Record level of wind installations installed, 66 gigawatts. For the first time throughout the history of renewables, additional renewable capacity surpassed fossil fuel capacity, which represented about 55%. And with these record level installations, there's also another very important thing what happened is that in terms of installed capacity, renewables surpassed coal, which is a major step forward that they may be surpassed in the future in their generation. So this is only about installed capacity. Currently, coal still generates about 40% of global electricity. Second thing, what happened last year in December in Paris, COP21 agreement, now in COP22 in Marrakesh, it took about 8 years to ratify Kyoto Protocol, and it took about 8 months to ratify Paris Agreement. So this is an unbelievable development, although there are question marks how this agreement will be implemented, but let's face it, it's an incredible development. So it creates momentum for renewables, and it creates policy momentum overall. As mentioned, the health effects of fossil fuels, not only climate change mitigation is a big driver for renewables, but there are two other drivers which are as important as climate change mitigation. Those are energy security reasons and air pollution, especially in Asia, which has a significant health effect. So energy investment in 2015 moved towards renewables, which I will show you how much it is invested in 2015. However, we are talking about the beginning of the story, which means if you want to go towards a 2 degrees or well below 2 degrees scenario that is signed in Paris, we really definitely need to do more, which I will come to that later. So what happened in 2015, we look at throughout the energy sector, how much investment that is made. And it was about 1.8 trillion only in 2015 that they're invested in the energy sector. So oil and gas still represent significant majority. However, one important note that there's a second year in a row that oil and gas investments decline, 25% each. This is due to the low fossil fuel prices. However, one important note is that renewables start to represent a significant majority of investments in the power sector. It's about 17% of the power, of the overall investment were renewables, and is about 2/3 of overall power investment came from renewables, which is an important development. So what we do, we produce this 5-year forecast every year to look at where renewable energy markets will go. And we forecasted last year about 700 gigawatts of renewable electricity installations. This year we improved our forecast by 13%. Why did we improve it? Because policies changed. So we saw the important policy changes over the last year, and these came from the United States with the extension of tax credits. It came from China with higher investment targets. And also in India with the better implementation of the renewable energy policies at the state level. So this led us to improve our forecast. One important news is that for the first time in our forecast, the United States renewable deployment will surpass that of European Union, which is the first time in the history. So we will see that in the future with the extension. However, just one note that this new government in the United States is not included in this forecast. So we did this before. So we will see how this changes. Next year, depending on the policies that Mr. Trump introduces, we will revise this forecast. So we are talking about, over the coming 5 years, 1.5 trillion of renewable energy investment. This is an important number to note, and it's important for the mining industry how much of this investment will be done by the mining companies, how much of the investment will be used by mining companies. And obviously, 3/4 of this investment will go to two main technologies, which are solar PV, offshore wind, and onshore wind. We are expecting about 250 billion, 50 billion invested in renewables going forwards up to 2021. So let's put things into the context. This chart will show you where the electricity generation is going. So this is an indexed chart, indexed to 2001, like over a 2-decade period. So we see that global power generation will continue to grow, mostly coming from the Asian markets. Oil and gas generation will not grow as fast anymore, especially coal generation growth we expect to decline. As of 2015, we will still have coal generation coming from Asia, but growth rate will decline. The same thing for gas, although at a lesser extent. However, the important thing to note is the green line here, which is renewables. We expect renewable generation to grow by 40% in 5 years. Which is a significant change in the power systems. And currently, renewables represent about 23% of global power generation. They will represent in 5 years about 28%, which means 0.8 percentage change every year, which is unseen. So in terms of how we see in 2021, 5 years from now, yes, coal will remain the largest source of generation, but the gap between coal and renewables will close significantly. And about 2030, probably, renewable generation will surpass coal and become the first fuel in the world. So when we look at how renewable generation growth is compared to electricity demand growth, this picture shows you a two-speed world, which is in Asia, demand is growing, renewables are growing as well, but they only represent a certain portion of the generation growth, which means that renewables will grow there, but in terms of the decarbonization, it will be slower compared to the countries on the other side of the chart, where renewable generation growth will surpass significantly power demand needs. What does this mean? Somebody needs to get out of the system, which means fossil fuels in this case. So we will see an important shift, especially in the OECD countries or developed countries, to go from fossils to renewables. And where is this power coming from? So hydropower has been the significant contributor to this, still is. However, its annual additions, which means the additional capacity that will be added from now on, will decline starting on 2015, because large-scale hydropower projects are becoming difficult to build, and there are environmental and social impacts which make them not acceptable on the one hand, also expensive on the other hand. So we will see more and more small hydropower projects and run-of-river projects coming online in the future. The biggest driver will be solar PV and onshore wind. And I would like to make an important point here. This bumpy road in renewable additions is due to policy changes. So we really need to take into account that majority of renewable capacity that is deployed over the past years and in coming years will be supported by policies. But supported does not mean that they require high economic incentives, but they require a market framework that they can operate. So, and And we will see this continue, that these policy changes create boom and bust cycles for renewables and give reverse incentives to investors. So we have seen in 2009 and 2012, US tax credit booms and then busts. We saw the Italy PV boom and bust afterwards. We saw the China feed-in tariff boom in 2015 for onshore wind. 2016, it will be a China feed-in tariff boom on solar PV, and it will be a bust. And there will be a bust in Japanese feed-in tariff. So we really need to take into account that these technologies are operating in a policy environment, and it will be extremely important to give them right incentives going forward. So these are the costs that we calculated. These are the weighted average costs of different renewables. You can see that in 2011 to 2016, solar PV costs decreased by 75%, and we expect them to decrease further 25% going forward. This is an important news. Where is this cost reduction come from? So module prices will continue to decrease, but modules only represent about 30% of an investment cost of a solar PV system. Other 70% is coming from non-equipment besides inverter. So which means that there's an incredible room for this non-equipment based part, which include financial regulations that these investments need to go through. There is insurance, there is all these other labor costs, licensing, siting, all these additional costs, which creates actually currently, when you invest in the United States in a utility scale plant today, is double the price that you are investing in China or India. We are talking about similar module prices. Where is this cost coming from is all these other costs that creates opportunity. We expect another 10% reduction, 10 to 15% reduction in onshore wind generation as well. This is the technology deployment which is getting basically more efficient, and we see bigger turbines and with higher capacity factors. As someone mentioned before, in Texas it's about 45% right now, and in many places it will continue to increase. However, this is the average costs. I would like to complete the picture that is shown in the previous presentation. These are the PPAs that are signed, a more complete the picture. We are basically trying to track every single PPA that is auctioned and signed globally. We have a database that we track this. We are also trying to track how much of these investments will be materialized. Not all of them will be materialized, but most of them probably will. And we are seeing a significant decline in operating. But it's also, we are seeing a policy change from government-set feed-in tariffs or government-set long-term tariffs towards a policy-driven auctions. And the competition actually changes completely the picture that renewables operate in, because we are talking about an industry where it's a nascent industry, it's a new industry compared to many others. And what happens with the competition is that you have different stakeholders, from banks, from manufacturers, from insurance companies, from all the other stakeholders and developers and utilities. They come together and understand the risks of renewables better. And then for the mining industry, having a sustainable and long-term contracts is very, very important to basically hedge your fossil fuel, volatile fossil fuel prices. And this new policy trend is a good opportunity, because it gives usually 15 to 25 years of PPAs that are fixed or inflation or dollar-based or inflation adjusted. But at least it gives you, it tells you how much of your energy price will be going forward. Let's go a little bit towards the mining industry. So at the IEA, we are the hub of the energy data, so we collect this energy data. And when we look at in 2014 how much mining industry represents a total energy consumption, So it was about 1%. When you add the coal mines, it's about another 1%. When you add metals and minerals, which means the processing of them, it's another 6%. And if you include, I look some of the companies are also working in iron and steel here. So when you add those, it's about another 6%. This doesn't include the transport needs because we account for those transportation energy use in the transport part. But overall, we see that mining and quarrying requires about 1/5 of the total industrial energy consumption, which is quite significant. And when you look at the composition of this energy consumption, compared to other industries, between mining and other industries, we see that mining and quarrying basically represent uses significant electricity. And last year, they used 50% of Canada's electricity consumption, all mining operations in the world, which is pretty significant. And still, oil represents the majority, significant majority of the investment after electricity, because most of the machines that are using diesel and oil-based products. There are opportunities here which are mentioned in the previous presentation about how do we decarbonize the transport sector, or how do we decarbonize the sector that is using diesel, which is a very difficult one actually. Either you electrify or you use biofuels, which have certain limitations in terms of how you can blend them in. But our biofuels forecast shows a significant expansion of biofuels going forward as well, but we are not sure if the demand is there on the mining industry. So these are the major mining companies and our forecast, electricity forecast for the major mining countries that we selected. And then we see that, and the dots show you the renewable electricity share over the overall electricity generation. And we expect in all of these countries that share of renewables will increase, which means that they will represent, they will decarbonize the mining industry's electricity needs as well. And more renewables will decarbonize indirectly your needs, but it's important to note that how much of this investment in these countries will be made by mining companies, or how much power will be bought by the mining companies going forward. One of the important trends that we observe is that new business models create an important opportunities for both utility scale and small off-grid implications. This is a corporate. This picture shows you the corporate buying of power from several companies in North America, and how much installations this represents. We saw a significant increase over the last 3 years of these investments. And this is due to economics, because they would like to have a sustainable power, and then they basically either sign contracts, or they are the equity partners of renewable energy projects, or they are providing debt sometimes through their financial institutions, and so on and so forth. And we expect this trend to continue significantly going forward, because it may move from North America, which is mostly concentrated, to other parts of Europe and Asia and Latin America. So all the forecasts that I presented unfortunately doesn't lead us to 2-degree scenario. So everyone needs to do more. So this is the annual additions of renewable electricity capacity that is going forward up to 2021. We see the capacity leveling off, basically. It's not growing. And this is mainly due to policy uncertainties and that we see in the market. However, with the improvements of these policy uncertainties, we have an accelerated scenario which can put back up the additions going forward. But this will depend on the policy action and how industries are willing to invest in renewables and to see the market going forward. Just to let you know, even if all the INDCs, the countries submitted their submissions in the Paris Agreement, even if all of these are implemented by 2030, we are not preventing the global temperature increase to less than 2.7%. And our target is about 2 degrees. So 2.7 and 2 degrees, this 0.7 point difference is significantly important to get into. We talked about power, and power is the most trendiest and sexiest topic in renewables, but there are 2 other sectors that are as important as power. One is transport, the other one is renewable heat. I saw a presentation before that heating requirements of the camps is significantly important, but heat on its own is a very difficult sector because it requires further attention of the policy consumer. It requires policy attention, but it's also based on the consumer choice. And some of the renewable heating options are more expensive than fossil fuel alternatives. And there's a room for policy improvement there. There are 175 countries who are supporting renewable electricity, but there are less than 70 to support renewable heat because it's difficult to support, and it's the very segmented business environment which based on the consumer choice. In the biofuels for road transport, its share is significantly lower than even renewable heat, but there are also opportunities there, but it's also expensive. Just to finish, these are the conclusions that we draw from our study, which means that we improved our forecast, but it's based on policies and decrease in costs. We need to know that the opportunities for renewable is not limited to mitigation. It's also includes air quality and energy security considerations. Only technologies who are on track to meet the 2-degree scenario is wind and solar. The other technologies are not on track at this point. The coal and gas competition remains important to decarbonize globally, which is happening in Asia right now. And we expect appropriate rules to invest in renewables. This is not an industry yet to be fully competitive in all around the world for fossil fuel alternatives. And new business opportunities for on and off grid create a significant business environment for renewables. Thank you very much.